Hello and welcome back to my channel. I'm Juliette. I'm a chartered accountant and a property investor. In this video, I want to share with you how to be tax efficient in property. As property investors, we want to be serious on income tax, capital gain tax, and inheritance tax. Before we even crack on with any of those, I want you to write down the following two important rules. First of all, never ever sell your investment property. And second, as the property goes up in value, increase your debt against it. If you feel a bit nervous about this last one, please have a look at my video on good debt and bad debt to understand why there is nothing to worry about it. Please remember to like this video if you enjoy it and you feel like you learned something, and subscribe to my channel if you haven't done it yet. Let's look at income tax. Let's imagine we have two identical persons, John and Emma. They are identical in every way. Identical job, identical income for the next 15 years, same age, and they buy the same identical semi-detached property, one next to each other. They both have a house that is worth £90,000. They pay 25% deposit and the remaining is mortgage, 67,500. The mortgage is interest only at 4.75%. This house will give them rent of £650 per month. The mortgage is £253, maintenance £80, building insurance £20, and letting agents £78. This gives them a net income of $219 per calendar month. And in really simple terms, it isn't exactly like this, but to keep it simple, if you are a 40% taxpayer, you pay 40% on this. If you are a 20% taxpayer, you pay 20%. No taxpayer, no taxes. It isn't like that at the moment, especially with Rule 24, but for simplicity and to check this principle, let's look at it this way. Let's imagine that John hasn't watched my video on good debt and bad debt, and he has a saver's mentality. He thinks all debts are bad. He decides then to pay off his mortgage in the next 15 years. Emma, on the other hand, she has watched my video and understands that there is a good debt and a bad debt. This one is a good debt and she decides to keep her mortgage and not pay it out. So what's the award that John gets in 15-year times when he has paid off his mortgage? If we fast forward to 15 years and he has paid his mortgage to zero, there is another £253 that will go down to the bottom line as net income. The government will come along and say, hey, you two, you have the same job, you have the same property, you have the same money coming in, but John, because you paid off your mortgage, here's the award. You will have an extra £100 a month to pay for tax. Congratulations. Everything is identical, but he has to pay £100 more only because he paid off his mortgage. Would you ever pay your mortgage down if you have to pay more taxes? First rule, we are not going to pay down the mortgage. We are only going to take interest-only mortgage. If you have repayment mortgage, you are paying it down. By the way, while John was busy repaying his mortgage, Emma was either having parties with those £67,500, or more wisely, she would have invested in other properties and she will now have 4 properties going up in value instead of 1. Another reason why not to pay your mortgage down. Let's talk about Emma now. Emma does not pay her mortgage down. She keeps the property with the same mortgage. Her rent is going up every year 3 to 5%. Her rent is going up from $650 to $670, $693, and then £710 per month. The problem is that this is going to put an extra £60 a month on the bottom line. She will have to pay more taxes. Now, over the next 3 years, some of the bills would have also gone up, let's say with inflation. So the maintenance will now be £90. The other thing that would also go up with inflation is the value of the house. Emma can go to the bank and say, hey bank, the house has increased value. Can I reborrow 75% of the new value? The bank will say, of course you can. You only need to pay a bit more mortgage. But that's fine. The increased rent will pay for it. Let's freeze for now the numbers. Let's assume that the mortgage goes up to £390 a month. Emma has now £60 additional a month coming in. But she also got an extra £50 and £60 a month of expense. Her net income remains the same. Her tax remains the same. If you follow up that second principle, if the property goes up in value, increase your debt against it, you stay income tax efficient. Now, this is a principle. It is a bit more complicated than that, but the principle holds true even with rule number 24. It works, and this is how you do it. I really hope you have enjoyed this video and learned something new. In the next video, I will be talking about capital gain taxes. If you are looking to start your property investment journey, or if you have some money but no time or no experience, please feel free to reach out to me and I will be happy to help.